Go.
Good evening. This is Stephen Leeb coming to you from Leeb, Leeb.com. Before commenting on the market today, I want to invite everyone listening to me to sign up for our free market newsletter. It's absolutely free, and we think it's very good. Anyway, getting back to today's market. Stocks, which started out with a bang today, threatening to go through past highs, finished on a very low note. They gave back nearly a 2% gain. The data today explains why stocks were having some problem. Perhaps the most significant data point that we got today was the so-called employment cost index. This is a measure of how much labor is being paid for their work, and that measure has gone down to all-time lows. Now, why is that so important? Well, go back to yesterday, where GDP data came out and on the surface looked worse than expected, but when the analysts looked into the details, they found some hope in the fact that consumer expenditures actually went up in the first quarter, rose by over 2%. Well, today's data on employment cost index, on how much employees are getting paid, suggests you cannot bank on rising consumer expenditures. In fact, it's much more likely consumer expenditures go down in the second quarter rather than continue the first quarter's trend. And indeed, so it is with so much of this very good data that we've seen lately, from bank earnings to GDP data, etc. There's very little in this data that suggests we're going to have continued improvement in any of these major economic variables. We have to admit, though we would love to be bullish on this market, we still think there is a big correction ahead. And we just have to caution you, not full in yet. This is not a rally to chase. We'll be back, and we will tell you when it's a good time to buy, because believe me, I would much rather be bullish than bearish, but unfortunately, this is just not the time to be bullish. Thank you very much. Have a very nice evening.